Wall Street poised for rally as European markets rebound, despite Trump and China trade tensions. As of April 8, 2025, global financial markets were caught in a curious tug-of-war between optimism and anxiety. On one side, escalating trade tensions between the U.S. under President Donald Trump and China loomed large, threatening to destabilize the global economy. On the other side, Wall Street was primed for a rally, while European markets showed signs of a promising rebound. This article explores how markets could stay resilient despite trade threats and examines the underlying factors driving these positive movements. Anticipated Wall Street rally, what's driving the optimism? When President Trump initially announced new tariffs on China, the market response was immediate and harsh, with many fearing the worst, a full-blown trade war. The panic was palpable, and the stock market reacted accordingly, tumbling on news of escalating tensions. As tariffs typically increase costs for businesses, investors feared that profits would shrink and economic growth would stall. But this initial downturn didn't last long, and Wall Street soon began to show signs of recovery. Several key factors contributed to this rally. First, after the steep declines in global equities, a staggering $10 trillion sell-off, investors began to seek bargains, thinking that some stocks had become undervalued. This bargain hunting is common after a sharp drop in prices, and many saw it as an opportunity to jump in before prices rebounded. Another reason for the rebound was the persistent hope that the trade conflict would be resolved through diplomacy. Even as the rhetoric from both sides grew more heated, markets clung to the idea that negotiations could still pave the way for a solution. A hopeful tweet or a public indication of dialogue could have an outsized impact on market sentiment. This optimism was bolstered by individual companies that performed better than expected, such as Levi Strauss, which saw its stock price rise after exceeding profit targets. Tech stocks like Nvidia and Supermicro Computer also showed strong signs of recovery, signaling that some sectors were better positioned to weather the storm. The Federal Reserve's anticipated response to the economic uncertainty also played a role in boosting confidence. The market anticipated that the central bank might cut interest rates to cushion the economic blow from the trade war, which typically benefits stock prices. The possibility of looser monetary policy helped keep the mood positive despite the geopolitical risks. European markets on the mend. Similar to the US, European markets were hit hard by the trade news, but by April 8th, signs of a recovery were emerging. A key driver of this rebound was a technical recovery as markets stabilized after a chaotic period of volatility. This created an environment where investors felt more comfortable re-entering the market, which led to a rise in stock prices across Europe. One of the factors contributing to the rebound was the European Union's diplomatic efforts to mitigate the situation. The EU signaled its willingness to engage in a tariff-free trade pact with the US, which was seen as a positive sign by investors. The hope that the US and EU might reach an agreement to avoid further escalation helped to lift European sentiment. Additionally, the rise in oil prices and the performance of safe haven assets like gold pointed to a shift in investor psychology. While oil's increase was seen as a signal of optimism about future global demand, the price of gold's surge suggested that caution still lingered in the markets. The improvement in European markets was also partly fueled by positive momentum from Asian markets, which had recovered overnight. As global markets are interconnected, positive sentiment in one region can often spill over into others, giving a boost to investor confidence worldwide. Escalating trade tensions, Trump versus China. The context for all of this market activity was the backdrop of rising trade tensions between the US and China. In the lead-up to April 2025, Trump imposed a 10% baseline tariff on all imports, and additional tariffs were aimed specifically at China. These moves escalated further with Trump's April 2nd threat to impose a 50% tariff on Chinese goods if China didn't remove its retaliatory tariffs. China responded firmly, vowing to fight to the end and promising retaliatory measures of its own. This hardening of positions seemed to guarantee a volatile market environment, especially as it seemed to rule out any immediate resolution. If these tariffs were enacted, the US would face the potential for much higher prices on consumer goods, which could lead to inflation and possibly even a recession. Economists voiced concerns about the negative impacts of these measures on global trade as the two largest economies in the world, the US and China, though, would be locked in a destructive cycle of retaliatory tariffs. Why did markets rally despite the threats? The paradox of the markets rebounding despite these looming threats can be explained by several factors. First, there was still hope among investors that the trade dispute could be resolved diplomatically. Even with the tough talk and the termination of trade talks, many investors believed that the trade war might not reach its most extreme levels and that an agreement could still be on the horizon. Moreover, the market had likely already priced in some level of tariff escalation. The fear surrounding the tariffs might have been overblown in some investors' eyes, and they took advantage of what they saw as an overreaction by buying stocks at lower prices. There was also the possibility that the market had already endured its worst phase and was now entering a period of stabilization. Corporate earnings continued to show strength, and this helped support the rally. Companies that exceeded expectations, like Levi Strauss and CVS Health, helped boost investor confidence that the fundamentals of the economy were still solid, despite the trade disruptions. Finally, there was the expectation that central banks, especially the Federal Reserve, would step in with monetary policy adjustments to counter any slowdown. Investors were betting that these interventions would support the economy and, by extension, the stock market. Conclusion: a cautious optimism amid uncertainty. In conclusion, while the backdrop of escalating trade tensions between the US and China created an environment of uncertainty, both Wall Street and European markets showed resilience. Technical rebounds, hopes for a diplomatic resolution, strong performances from individual companies, and expectations of central bank intervention all contributed to the positive sentiment. However, the underlying risks associated with the ongoing trade war remained. The potential for higher tariffs, inflation, and a global recession were real concerns that continued to cast a shadow over the markets. As the situation developed, investors would need to remain vigilant, monitoring key indicators like inflation data, corporate earnings, and any progress in trade negotiations to assess whether the rally was sustainable or merely a temporary surge amidst a storm of geopolitical risks.